couple of different routes to go public. There is the initial public offering, or IPO, which you would hear about quite often, and the other possibility is a non-offering prospectus, or NOP, and they're both quite similar in that the process involves filing a prospectus, which is a full disclosure document that discloses everything about the company and its management and its share structure, and including what the opportunity is that they are going public with, whether it be a mineral property or some other sort of tech deal, some other kind of business opportunity. Either one can be taken public through an initial public offering. Historically, those would be done with or through a brokerage firm here in Canada, but not necessarily. When we were in the thick of company creation, a group came to us that wanted us to do an IPO. So I said, okay. And when we first filed it, all the securities commissions across Canada freaked out and phoned us and said, well, yeah, but who's going to hold the money? I said, our securities lawyer. Oh, and it went through. Unfortunately, that company didn't do that well, but that's the nature of the beast when it comes to new offerings in either on the CSE or through the TSX Venture Exchange. They're both considered high risk opportunities with high potential rewards. So some of the criteria would include that the company needs to have on the CSE, that have to have 150 shareholders. In reality, you need more like 180 or 190. On the TSX Venture Exchange, you'd need a minimum of 200 shareholders, but there again, in reality, you would probably want 225 or 250 that then would be considered public distribution. The third route, which a lot of people think is faster, I hope you're listening, Brandon. A lot of people consider faster, although that certainly isn't the case. That isn't always the case, because when the new opportunity is going into an existing public company, commonly referred to as a shell, because it doesn't have a viable business opportunity. Typically, the number of shares that would be issued to the incoming opportunity would cause it to be a reverse takeover, which means you're going to have to file similar documentation as to the non-offering prospectus or the initial public offering. The only advantage of the reverse takeover is that in all likelihood you would have public distribution through the company you were taking over. And that public distribution is a fair amount of work. The disadvantage in an RTO like that is that your shareholder base would not have bought into your deal. They bought into somebody else's deal that didn't work out. And now they're being rescued by this new opportunity, which probably included the ugly word that in Canada, we call it a rollback, and sometimes referred to as a reverse split, which is kind of a confusing term, but they both mean the same.